I guess I want to publicly announce that George Orwell lives. I've listened to my colleagues on the Republican side, and I really can't believe there's either two conclusions I can come to. Either you all failed to read the bill that we passed here in this committee and in the House, or you are purposely attempting to mislead the American people as to the real content of that bill. When you say that we don't have protections in there that never existed before, you're just dead wrong. And I call your attention to the amendment that I offered, the too big to fail amendment, that passed this committee and is part of the House bill that will prevent in the future and give authority to these regulators and others the ability to stop institutions from growing so large that they will systemically challenge the American system. That's the first time in history. And yet everyone on this side of the aisle seems, and particularly not only the members present at this committee, but I listened over the weekend to these talking heads. I listened this morning to some of the senators. Now, we've got to get everybody together here to accept the fact, what are the basic facts, or we're in trouble. And along with that, I'll direct my questions, Mr. Secretary. We need a system, but we really need a system. And I've listened to your testimony very closely. I listened to Mr. Bernanke very closely, and Ms. Shapiro very closely. And I didn't hear you mentioning the too big to fail amendment, where we have authorized the appropriate regulators to move in, take control, and order large banks and institutions that challenge the risk to our system, and either force them to break up, add capital, or take other actions that would reduce their risk. Now, is there a reason I'm hearing you not mention this in this testimony?
Mr. Chairman, you're exactly right that critical to any effective reform and at the center of the bill this committee passed are a set of authorities to limit risk taking across the financial system. And as part of that, you proposed and the committee embraced a provision to give explicit authority to the Federal Reserve to limit risks ahead of the crisis. But I completely agree the best way to deal with too big to fail, the necessary part of reforms to deal with that is to make sure you have people that are equipped with authority to put effective constraints on risk-taking ahead of the crisis.
Now, the question on that, and it was raised by Mr. Volker, have we been too nice and just say that the regulators have that authority, or should we mandate the use of that authority?
Well, Mr. Chairman, as you know, in the bill that Senator Dodd has proposed in the Senate, he takes an approach building on the model you laid out, which does impose actual limits and does require the Federal Reserve, would require the Federal Reserve, if passed, to design regulations that would apply those limits. So it includes your broad grant of authority, but accompanies that with an explicit requirement that clear limits be put in place.
I appreciate that. Mr. Bernanke, Mr. Chairman, I'm going to ask you, I didn't hear in your testimony any discussion of the too big to fail amendment as proposed by this committee and passed in the law in the House at least, and now part of the Senate bill in modification. Is there a reason why important elements of this administration and the regulatory leadership of this country are not taking a public position on this issue?
No, sir. I'm very much in favor of addressing too big to fail. I think it's a major concern, and the two lessons I drew on consolidated supervision and a resolution are two big parts of a too big to fail strategy.
They are. Well, I didn't hear your comment on the amendment that I offered in this committee as part of the House bill and now part of the Senate bill to a point, giving the authority to the regulators to intercede, require plans, require additional capital, break down organizations that are too large to fail. Is there a reason why you failed to address that?
Well, we were discussing Lehman, which was near the end, but in a crisis, prior to the crisis, you want to take actions necessary to limit risks, and I'm very sympathetic to the view that through capital, through restrictions on activities, through liquidity requirements, through executive compensation, through a whole variety of mechanisms, it's important that we limit excessive risk-taking, particularly when the losses are effectively borne by the taxpayer.
Mr. Chairman, you dance well. Are you going to answer my question? Are you or are you not in favor of the law as passed by the House and incorporated in the Senate bill authorizing the regulators with greater authority to break up organizations if necessary that are deemed to be too large to fail?
I think it's something that would be on the whole, constructive, and I'm certainly, as a regulator, certainly willing to work within its dictates.
Madam Chairman?
Thank you. I would agree that having that authority for regulators is actually quite critical. And I would point to the example of the CSE program to illustrate that, because that was a program that lacked a statutory basis, and despite its many other flaws, which I'm sure we'll talk about further this morning, there was no authority on the part of the regulators based in statute to take dramatic or substantive action with respect to imposing requirements upon the investment bank holding companies, and I think that was a huge flaw of the program.